I'm Judy Shaw for NYSE Floor Talk. Joining me today is Jay Jacobs. Jay is the head of research and strategy at Global X. Jay, thanks so much for joining me.
Thanks for having me.
Jay, one quick note to our viewers before we begin. This interview is for informational purposes only. The NYSE doesn't make any recommendations or provide investment advice, and we're not endorsing or recommending Jay or Global X. Jay, what's the impact of the Fed setting interest rates at zero, specifically on income-oriented portfolios?
Well, investors have struggled to find income, for the greater part of a decade now. So, most income-oriented investors are no stranger to struggling to find yield. The challenge is when the Fed takes the federal funds rate down to zero, it just makes it even harder to get that income from traditional sources, mainly being, fixed income, government bonds, investment grade bonds. So when you look at the current fixed income landscape, a few things become clear. One is duration is just not paying any yield. You can go out, to the 10-year treasury, even the 30-year treasury, and the yield is, just incredibly low. It's not enough for people who look at their portfolio and are trying to generate, call it 3 or 4 or even 5% yield from their assets. So where do you get that yield? Well, in the fixed income space, that means you have to take more credit risk. Even investment grade bonds are not providing a ton of yield right now. So people increasingly are kind of overloading the high yield credit space. And in this environment, you're certainly taking on a lot more kind of business continuity risk if you're looking at high yield bonds. So it's not suggested that an investor just purely kind of pile into the high yield bond space. An area that we really like is the preferred stock space. Preferreds are really a hybrid between bonds and equities. They tend to pay pretty high yields. They tend to be investment grade companies in nature, but preferreds are junior on the capital structure and therefore kind of provide high yield like income, but from investment grade companies due to that structuring. And I would also point out two other things. One is a lot of preferred distributions are tax advantaged. They're taxed as dividend income, often not ordinary income. So that can be better for taxable investors. And then in this environment, a lot of companies who have taken loans from the government during the COVID-19 crisis might actually not be allowed to pay out dividends. That affects common stock, but that does not right now in the legal framework affect preferred stock. So we think that's going to be more insulated from any kind of government mandates to limit distribution. So we're really looking at the preferred space as a nice complement to the high yield income space for people looking for more yield.
Okay, well, let's talk about bonds. How do low rates impact the utilization of bonds within income-oriented portfolios?
Yeah, well, just like we said, it's really a challenge to get that income from those traditional sources, right? So, in the 80s, you could have just bought government bonds and been flush with income from them, and that's just not the case anymore. So it does require going out on the duration curve, going out in terms of looking for more credit, or just getting more creative and looking at areas that really exist outside of the traditional fixed income space. So, unfortunately, I think it means that having that core bond portfolio now is a portfolio stabilizer, but it's not an income generator. In the past, it used to be both, and that's the challenge for investors.
Okay, and how about equities? What are your thoughts for equities right now in a low rate environment for income-oriented portfolios?
We think equities can be pretty attractive for investors, but there's a few things to keep in mind. So, if you look at longer term structural trends, you have people living longer than ever before and depending on their retirement income longer than ever before. So we like equities because dividend payments can provide income as well as a growth component that is critical to investors who are looking to live off of their savings for 30, maybe even 40 years in retirement. We also like that equities have tax advantage distributions again, so a lot of qualified dividend income can go further on an after-tax basis. But within equities, it's complex because as we were talking about, the government might mandate that some companies that take loans have to cut their dividends in the future. And so that's going to be a real shock to some investors who are depending on those dividend payments on a regular basis. We think one area of the market that's going to be more resilient is what we're calling quality dividend payers. Those are stocks that have low debt, so they're less likely to need to go to the government for a loan right now, and they tend to be more profitable. because they have a great scale or great moat around their business. You combine those two factors with kind of the dividend aspect, and we think that's going to be a more resilient space in the market going forward, where investors who are looking for that equity income might have a little bit less risk on the dividend cut side.
Okay. And Jay, finally, outside of the traditional fixed income and dividend stocks, what are other potential options for income-oriented portfolios?
Well, I would encourage all investors to not just think about the two buckets of fixed income and equity. There really are more strategies to generate income in a portfolio. One area where we've seen a lot of interest recently is in covered call strategies. This is where you essentially buy a stock and sell a call option on top of that stock to generate income. So it does cap some of the upside, but essentially you're getting the option premium as in the form of income. So you're kind of giving up that upside in exchange for a monthly recurring income. We've seen that's a strategy that can generate a lot of income in this environment where volatility is quite high, and it's a very diversified source of income. It doesn't really depend on what the government does with distributions and forcing companies to cut dividends. It doesn't have a lot of duration risk, so it doesn't have a lot of sensitivity to interest rates. It's a completely different source of income. And in this environment where people are really looking for where can I get income, how can I diversify my portfolio, we think it's critical that people expand that opportunity set to include other strategies that are going to be diversifiers in their portfolio. I think covered calls can be a great way to add that different strategy into that portfolio.
Jay, thank you so much for joining me on NYSE Floor Talk.
Thank you.